Today's little missive or diatribe is quite fortuitous because it coincides very neatly with a discussion that's occurring within our mentor program at present. When one deals with novice or inexperienced traders, they bring with them certain baggage. One profound piece of baggage that they bring is the notion that trading must be inordinately complex. Within that complexity, there must be an answer, if only one could understand and master the complexity. I can understand on several levels as to why people might think this is true about trading. Initially, trading looks to be very, very difficult. It looks to be very complicated. There's an inordinate amount of information that one must manage as a trader. So I can see how new traders would fall into that trap. In many instances, this desire for complexity among new traders is manifest in the notion of plastering the chart with indicators. There is a belief that indicators, because of their complexity, will in some way assist you. However, I think there's a more important point here with regard to complexity, and it's an emotional point. If you come across an endeavour that appears extremely complex and you cling to the illusion that it is complex, when you fail, it is not that bad, because you have this automatic comfort factor built in. You can say to yourself, it's enormously complex, it's very hard, very few people can do it, so therefore I shouldn't be expected to be able to do it. So I understand that. I also understand within novice traders the desire for indicators, because what trader would not want to be able to predict the future? Unfortunately, this is an extremely difficult habit to get people out of, and it's a little battle that is going on at present within the mentor program. There are always people who want to desperately cling to indicators to completely obscure the purity of price action with a bunch of fairly meaningless lines. The interesting thing about this is that this is not necessarily a characteristic of just new or novice traders. There are large numbers of technical analysts out there who fall into the same trap, who believe that somewhere there is a magic indicator. For example, Metastock, the program I use, probably has 100 plus native indicators. There are then an additional several hundred that you can download into the program. The interesting thing is that if indicators made people profitable, then everybody who used Metastock or any of the other charting packages out there would be profitable. And part of the difficulty of getting people out of the habit of indicators are tables like this. This table's been doing the rounds of the Google box for the past few days. What it effectively does is it ranks a series of instruments based upon weather, based upon a 14-day relative strength index, the RSI. They're overbought or oversold. There's a few problems with this. The first is, how do you make a trading decision based upon this information? But secondly, and more importantly, overbought and oversold are relative emotional terms. They're like cheap and expensive. They're words that don't actually have any currency within trading per se, because these emotive terms mean very little to us in the actuality of trading. But more importantly, it contradicts other sentiment-based indicators. For example, this is the VIX, and I've spoken before about the efficacy of volatility-based indicators, that they're less than advertised, but in some instances they're better than expected. This chart directly contradicts the one before it, yet they're both sentiment indicators. What the VIX is telling me here is that the levels of volatility we're seeing within the market have not been consistently this low since the mid-part of the bull market that ran from 2003 to 2007. So we have two contradictory pieces of information. Both are sentiment indicators. So the question becomes, in the mind of the trader, which one has the greatest weight? Fortunately, there's an easy solution, and that's ignore them both. Because the issue that has the greatest weight is simply this. This is a chart of the Dow going back to the late 1890s. Yes, I understand there are methodological issues with this, but for a simple proof of concept, it will suffice. When you look at this chart, and this is a semi-log chart, you can see 4 boxes. You can see 4 multi-decade periods of congestion. One at the beginning of the 19th century, one at the mid part of the 19th century, one in the latter part, and one as we ran into the year 2000. Within these ranges, the market does trade in a very large range. So from the perspective of a trader, this sort of range is tradable. The current range on the Dow is sitting at nearly 800 points. For an index trader, that is more than sufficient. But the point here is twofold. One is, the market can go sideways for decades, a point that is often overlooked. The second is that based upon history, what we see is that when price breaks out of one of these points of congestion, the market runs for several years. Now note, I said when price breaks out, not when an indicator breaks out, when price breaks out. Price is the purest piece of information we have. All indicators are iterations of price, so they take you further and further away. So we have an historical case upon which we can base a judgment. Now, it is quite possible that history might not repeat itself. That's perfectly acceptable within markets. Markets are not clockwork. They're not a perfect Newtonian universe. They're very dirty in the way they present themselves. They have to be dirty because all they are is an aggregation of humans, and humans are irrational and illogical. But if we look at what's happening at present, we can see this very large range over which the Dow's traded, and we can see it attempting to break through this congestion and make a new high. I say attempting because we won't actually know what has happened until a year or two in the future, and we look back and we can make a post-dictive comment on what has happened. This is the issue with trading. Trading is chaotic. You exist in the unknown. Nobody has any idea what is going to happen. We work simply on probabilities. And so you need to adjust your own psychology to that. And here in part lays the attraction of indicators. They attempt to convince you that this uncertainty is being removed, when in actual fact it's not. Markets will always be uncertain because whenever we look at price, we're looking at the extreme right-hand edge of a chart. We don't know what the future holds. So the issue, and this is the paramount issue, is that the question that needs to be asked, and this is the primary question of all trading systems, is simply what is price doing? Not what is an indicator doing, but what is price doing? Is price making new highs? If price is making new highs, then that is very good for people who are bullish. If price is making new lows, that's very good for people who are bearish. What you have to do is to adjust your thinking to match that, so that your thinking becomes simply a reflection of this question. The question is never what do you think the market is doing. The question is simply what is price doing.